So Raj Gupta, thank you for joining us. As you know, for many years, I have admired your work, and when I'm somewhat confused about what I want to do with my clients' money, I oftentimes turn to you. We've known each other for basically 25 years, and you are now managing partner over at Seacrest Investment Management. And prior to that, I think it's important a lot of people know that you at one point managed and oversaw $180 billion at Morgan Stanley Asset Management. Guys like you are always kind of behind the scenes, which I hope doesn't continue to be behind the scenes, but making all these really important decisions for portfolios. So thank you very much for joining me.
My pleasure.
What I'd like to do is really dive directly into a couple of very important points that people tend to miss when we're looking at portfolio management. And the one theme in 2012, Raj, was what is happening outside of our borders and how is that going to impact our portfolios domestically? And you're really an expert at understanding the international market. So will you touch a little bit on how do these events, when we look at what's happening in Europe and we see what's happening in the Middle East, how do they directly affect the stock market in the United States?
Well, Ed, international markets have always been a very significant factor impacting our markets, more so in the recent times than they had been perhaps 15, 20 years ago when you and I had a lot less gray hair. Right. But the bottom line really is that international markets do have a significant impact on both the U.S. equity and U.S. fixed income markets. The challenge that investors in the U.S. face, many of them, is really the lack of knowledge or in many cases the lack of information from some of those countries. You've heard many times, for example, that we can't rely upon the data that comes from the Chinese government, or that there's a lot of corruption in the data that comes from some of the more some of the smaller, more developing nations. But really, if you take a look at the globe as a whole, today, for example, if you exclude the U.S. fixed income market, and I'll come back to the U.S. equity market in a second, but if you exclude the U.S. fixed income market, 50% of the rest of the bond market is made out of Japanese bonds. And yet, I'd say probably about 90%, 95% of the people don't know that. The question then becomes is, what do you do with that information? Do you go heavily into Japanese bonds? Well, we happen to believe that the Japanese bonds are essentially a currency play because you're not going to get a whole lot of income. So similarly, on the equity side, some of the most rapid growth that we are seeing today, that we have seen in recent times, and that we will see, I believe, for the foreseeable future, is really going to come from some of the nations outside of our borders. That doesn't mean they're just going to be emerging nations. There'll be nations that are coming out of the 2007, 2008 sort of black hole that everybody fell into. They're coming out of it with stronger balance sheets. Emerging nations are doing a better job of it because they have demographics that are supporting them. They have natural resources. They have energy, amongst other things, that are supporting their financials. So it is important to understand all of those themes that are manifesting themselves in the global marketplace, both in the equity as well as in the fixed income markets.
Well, Raj, one of the things that you touched on just now is the Japanese bonds. And one of the things I'm starting to hear a lot about is that Japan is basically insolvent, even though we're not getting any income off of those bonds. Talk about the Japanese market, because it's either the second or third largest economy in the world, and there's a lot of fear there that we need to help investors understand the perspective and really get an understanding of what does Japan mean to our markets and our portfolios.
Sure. Let me put it in a perspective, in a relative perspective. You mentioned the size of the market. Clearly, it is the third largest market in the world by capitalization. Mm-hmm. But if you take a look at the Japanese market, it is indeed, if you just look at the traditional measuring methodology, it is insolvent. Their debt to GDP ratio is in excess of 220%. Compare that to far lower percentages for the so-called PIGS nations that you've heard so much about in the last 2 to 3 years in Europe. I compared that to about 100% in the United States. The issue that people need to understand about Japan is that despite their huge debt load, they've been able to, I would say, weather the storm, and I put that in quotes because they really have a lot of issues still. but they've been able to weather the storm because of the extraordinarily high savings rate of the population in Japan. As a result, they've been able to fund their own deficit to a large degree. So when I mentioned that it's almost 50% of the non-US fixed income markets, a lot of that debt is in Japanese debt holders' hands, and so there's not been as much demand. Unlike the United States, where a significant part of what the United States has borrowed vis-a-vis Treasury issuance is owned by foreign nations, China being one of the largest creditors to the United States. So what does that mean for Japan? Well, look, the Japanese stock market closed very close to 40,000 in December of 1989. So they've had 23 years of you can call it recession, depression, whatever you want to call it. Really, it's been a terrible time, and yet the country, from a financial standpoint, essentially has been bankrupt. Now, what they have started to do is the new administration is starting to essentially devalue the Japanese currency. The Japanese yen has gone from the high 70s more recently to the low to mid 90s, an incredible amount of devaluation in such a very, very short period of time. And that, many people have noticed, has given a boost to the Japanese stock market. The stock market is up very nicely.
Why is that? I mean, touch on that, because most people don't understand when a currency is devalued, very similar to what we're doing here in the United States, devaluing our currency by printing money. We make our exports look more attractive to people outside our country. Is that what the reason that Japan is devaluing their currency?
That's exactly right. And in fact, if you take a look at exports that the majority of the people are familiar with, take a look at Honda stock, take a look at Toyota Motors. These kind of companies have done very well because by lowering the value of the yen, they are essentially making their product, if you will, cheaper to foreign entities, foreign nations, foreign people, and they will buy more of their products. So that has been absolutely at the base of what has given a significant impetus to the Japanese stock market in the recent past.
And we just saw a report that Venezuela devalued their currency. We're devaluing our currency. You see Europe devaluing, in the Eurozone. I mean, Draghi is printing more money, and they'll say they won't stop printing money, which in effect devalues the currency. I mean, is it basically a race to the bottom, and where do you see this ending?
Well, you hit the nail right on the head. It is a race to the bottom, and the question is, who's going to do a better job of it, because they're trying to position themselves as the nation that people should be importing from, so that they can improve their balance of payments. I think at the end of the day, it is very difficult to predict where this is going to end, because, as we're well aware, central banks have an unlimited printing capability, as we have learned from the multi-trillion-dollar balance sheet that our Fed now sports. So as a result of that, though, if you are looking at it from an investment perspective, I think longer term, there's a good valuation, a good potential valuation of gold. You've seen gold go from 300-400s in the 90s to where it is today in the 1650 range. I think that is going to continue to be an option that people are going to take advantage of. Central governments have been taking advantage of that. Gold purchases have gone up with central banks. You might recall early last year, approximately, I believe it was early in 2012, when the Indian government purchased an incredible amount of gold, and that gave gold an impetus. So people are looking for that so-called hard currency. We are fortunate, the United States is fortunate to have the currency that everybody looks to at this stage of the game. But at some stage of the game, if people believe that dollar is going to continue to devalue, people will look at other resources. And I think gold has been the beneficiary of that. I think energy has been the beneficiary of that. We've seen the recent decline of the dollar resulting in a move up in Brent crude, setting aside what's happened in the U.S. oil market because of shipping issues. But I think people are going to look at alternative opportunities to allocate some of their assets to outside of the traditional, if you will, stocks and bonds.
And I agree. I mean, Dalio from Bridgewater just recently said, buy anything. Just, with interest rates being as low as they are, buy anything. And, he has quite a bit of money under management. But, here we are, Raj Gupta, at this moment in time, this very day, February 13th, 2013. We're looking at the world, and you have a great background, as we know. You've managed almost $200 billion over at Morgan Stanley Asset Management. You're at Seacrest Investment Management now, managing a lot of money. And when you look at the world, with all of your experience, give me the thing that you have the greatest fear about, and then what is your specific remedy for that? Where do you see money going, and where would you like to see more money placed for clients, not necessarily your clients, but just overall? What is your big hint for people right now?
Sure. I think what keeps me up at night, if you will, is always it is a conundrum. It's always the unexpected.
Right.
If people expect certain things to take place in the marketplace, market adjusts itself to it. Whether it's the buyers who think now that interest rates are going to go up, that they have to go up. Tell that to the people who said interest rates are going to go up in Japan in the late 1990s, and then in the early 2000 timeframe, or the late 2010 timeframe. And guess what? Interest rates remain very low despite an incredible amount of debt outstanding and increasing. So what really keeps me up at night is, what can be the unexpected that might manifest itself. So, for example, French debt overall has been increasing, and France has some issues now. Portugal is a small nation on a relative basis. Spain is a small nation, albeit significantly bigger than Portugal. But France is a huge economy. So could something potentially go wrong in France, a la what happened with the pigs nations,
right.
and could that drive a significant sword, if you will, into the recent euphoria that we have seen in the global markets.
But then take that comment. How does that impact investors in the United States? Because we tend to have number numbness. We see these reports. We don't understand how does that directly impact me. So how does that problem in France potentially affect our portfolios?
Well, it may not impact your portfolio directly on day one, but as we learned, as all of us learned very painfully so back in the 2008 timeframe, that something happening, whether it's in the PIGS nations or whether it's happening here in the United States, for example, the housing crisis, how global an economy we live in and how one part of the economy has a very significant impact on other parts of the world and other economies and other currencies and so forth. So my recommendation, and this is one of those things, Ed, that you and I have spoken about many years ago, which is really take a look at the basic tenet of investing. And the basic tenet of investing is, let's not try to hit home runs. Let's try to hit those singles. Let's try to hit those doubles. Let's diversify our portfolios amongst stocks, amongst bonds, amongst commodities, amongst real estate. And that way you have a built-in mechanism to hedge, if you will, any one part of your portfolio with another. You can take a blended benchmark, for example, of 60% equities and 60% global equities and 40% global fixed income. And what you would find is the consistency of return and the lower volatility, if you will, of those returns has been a desirable place to be in, over the last decade. Now, you go back over the last 10 to 13 years since the beginning of 2000. And if you go back and look at any particular segment, for example, gold, that's done nothing but essentially go up. Equities, for the first 10 years, basically did nothing, zero return on U.S. equities. So what you really want to do is have a well-diversified portfolio. And by well-diversified, I'm not just talking within the United States. I'm talking about a global portfolio that's diversified. Some of the greatest economic growth will come from nations that have extraordinarily positive demographics. Take a country like Brazil that has nearly 2/3 of its population below the age of 27 or 28. Take a look at a country like India. Take a look at a country like China, where there's a lot of young population. Again, I'm not suggesting that you take all of your assets and put them into any one of those countries.
Right.
What I'm suggesting is that diversification is the name of the game, and more often than not, people who try to hit those home runs, they will strike out, and that's something that we never want any of our clients, be they institutions, high net worth individuals, or frankly, kind of the average individual, you never want any of them to lose very hard-earned money, whether it's at the corporate level or at the individual level.
Well, I want to go back to one thing, because these countries that we talk about, Spain and Portugal and France, if there are problems there, they impact our markets because we have products basically that we are selling in those countries, and if those markets are hurt, they're not going to be able to buy our products, and that's why it impacts our stock market. Is that fair to say?
That's one element of it. Another element of it is that the banking system is so intertwined on a global scale that a bank suffering a significant issue, if you will, what impact that might have on some of the banks where they might have relationships in the U.S. or, for that matter, anywhere else in the world. So it is the product side of it, if you will, what they're producing for us, what they are importing from us. So that obviously has an impact on valuation of the relative markets, but also in terms of what intertwined relationships these countries have with us and we have with them, and what impact that might have on, in turn, if you will, on the financial investments that our investors make in that nation or domestically, which has an allocation to them.
Well, and last but not least, I want to just address the bond market in the United States, because that is where, you ran this big government fund at Morgan Stanley for many, many years, and you're far and away an expert in many areas, but specifically in the bond area. I have been advising clients to be fearful of that, even though we don't know that interest rates are going to rise, and the government says that they keep the discount rate and the Fed funds rate low. But the other interest rates on other bonds move up and down based on the free market. What do you think? Where do you see that happening? Because I remember in 1994, we saw interest rates rise, and we saw people in fixed income lose a lot of money. I'm very uncomfortable for my clients what is happening in that sector of their portfolio. What are your thoughts on that?
And it's a great point. And if you listen to the dialogue recently in the broad media, to a man, to a woman, to an investor, everybody believes that interest rates are headed higher, and considerably so. I believe that interest rates are going to head higher, but it's going to be a gradual rise. Again, the only caveat to that is the unexpected. Right. If something blows up somewhere in the world, could be the United States, what impact that might have. But setting that aside, setting the unexpected aside, I think interest rates are going to be generally biased modestly to the upside.
Gotcha.
Having said that, the opportunities still exist. You don't have to invest in long-term treasuries. There are shorter-term treasuries. There's a laddered portfolio approach. There are certificates of deposits in lieu of short-term treasuries. There are corporates out there that have attractive spreads over and above treasuries. There are corporates abroad, high-grade corporates abroad that have a spread above treasuries that's very attractive. There are emerging markets that have both corporates and sovereign debt that is significantly above treasuries. Let me get back to the point I made before, which is if you take a look at the totality of the bond market around the world, and you invest judiciously in the different subsectors, and you invest in a manner that allows you to diversify in those subsectors, what that will lead to essentially is a well-diversified portfolio providing you a good level of income and a hedge. Now, how do you protect yourself against rising interest rates? Well, the way you do it is simply by owning shorter duration securities. So if a benchmark that you're using for your clients happens to have a duration of 4 or 5 years, well, I think a duration of 3.5 years might be desirable. If you don't want to buy an exchange-traded fund that represents the broad bond market, or if you don't want to invest in a mutual fund that represents the broad market, you can always go out and buy individual bonds. So the idea of laddering your portfolio with individual bonds can be very appealing to the average investor in today's marketplace. For professional investors, I think it behooves them to be invested in a combination, perhaps, of bonds, ETFs, mutual funds, whatever their desire may be, and whatever they have available to them. But keep the duration, keep the average maturity, keep the risk level a little bit less than the benchmarks. Again, I cite the fact to you that Back in the mid-1990s, Japanese interest rates were low. People expected them to rise. Got to 2000, they remained low. People expected them to rise. Another 5 years later, the same thing. Another 5 years later, same thing. And again, here we are in 2013, and interest rates continue to be extraordinarily low in Japan, a market where the debt to GDP ratio is 220% plus.
Right. It reminds me of a quote that a man that you knew very well had, Jack Vandervliet, and that is, you pay a dear price for consensus on Wall Street. And,
exactly. And that's why I started off my comments about the fixed income market by saying, to a man, to a woman, to an investor, everybody expects interest rates to go up, and you and I have been around long enough to know that when that happens, it's unlikely that in the immediate future interest rates will go up in any dramatic fashion.
True. Well, Raj, I appreciate it. We've been talking with Raj Gupta, managing partner at Seacrest Investment Management. Raj, you're a good friend and obviously very knowledgeable in this, and I appreciate you taking the time.
Yeah, it's always a pleasure speaking with you. Thanks.
Talk to you soon. Bye.
All right. Bye.